Hello, and welcome to the Logistics Management Podcast. My name's Jeff Berman. I'm Group News Editor for Logistics Management Magazine, as well as the Peerless Media Supply Chain Group. Today, I'm really happy to bring back Keith Prather to our podcast. Keith serves as Managing Director and co-founder of Armada Corporate Intelligence. During his more than 24 years with Armada, Keith has consulted to Fortune 500 and companies of all sizes, providing corporate intelligence, economic forecasting, and insights on changing global dynamics, geopolitics, supply chain issues, and other factors that affect the corporate operating environment. Keith has spent several years working with clients in the transportation and global supply chain industry, providing strategic support and insights on the global operating environment. He's also a former CFO and the chief editor for the Flagship and officer of the Watch Report, read by more than 18,000 corporate executives on a weekly basis. He and co-founder Chris Kuehl present keynotes on the economy at more than 120 events per calendar year. Hey, Keith, welcome back.
Hey, thanks, Jeff. I've been looking forward to this.
Yeah, absolutely. Me too. I
I
know.
wish there was some news out there we could talk about.
I know. Gosh, there's more than a few things going on here. Why don't we start with the basic part, or allegedly the basic part, and we'll work our way from there. And that would simply be, Keith, if you could just shed a little light on the current state of the freight economy and all that that encompasses. There's so many things within that that we all need to pay attention to, right? Whether it's retail sales, inflation, manufacturing, and industrial economic data, the list goes on and on. So why don't we start with that and we can drill down from there?
That sounds great. Yeah, so in January and February, we're getting data. Some of it lags just a bit, but we've got a bunch of questions, okay? Because we're getting some decent signals. We thought this would happen coming out of 2 to 3 years of what we call a destocking cycle worldwide. And so we know that
Yeah.
inventories got bloated. We're trying to get those inventories back down. 2025 showed that reset happened. And so then early in 2026, we are seeing some nice upticks, right? A lot of carriers are reporting that their volumes are ticking up a little bit, but they're not extravagant. And we're moving along. What we don't know, Jeff, is that there was a lot of things happening to us at the beginning of the year. Let me give you one for instance. The Lunar New Year, for instance, just the timing was much later than usual. And so what we don't know is if some of the January lift that we saw and some of the new order activity, some of the freight transportation activity was shipments that would have been normally, scheduled maybe for December, or orders would have been scheduled for December that
Yeah.
got pushed into late January, early February. So we think there was a little bit of a timing issue there with the Lunar New Year. So what we're trying to do is strip out of all the freight dynamics and all the freight data that we're seeing, sort of the impact of the Lunar New Year to see how much is real, how much is just fundamental, supply chain activity and rebuilding of inventories coming out of the holiday season. And generally, again, when I listen to carriers and I look at the fundamentals of the market, for now, even with all the noise that's out there and all the fear that's out there, we have a fairly stable consumer who's buying, a lot of discretionary items, but they're small ticket items. They're not buying automotives, they're not buying cars or vehicles, and they're not necessarily doing, big long-term debt types of things. But we just got retail data out today, and they seem to be spending. So I think the consumption side of things seems to be stable enough that this
Right.
positive freight trend ought to continue. And last thing I would say, sort of on that note, is the last data that I saw from an inventory perspective said that most supply chains are still pretty lean. And I know as we go through, we're going to talk a lot about some of the events happening worldwide, and I think that ushers in maybe some concerns about whether we're going to hit a supply chain scramble phase at some point where companies are trying to remain in stock. And I think that'll be something we'll have to watch.
No, no question about it. One thing that caught my eye this week, Keith, was the monthly report, the manufacturing report from the Institute for Supply Management, or the ISM. And as we all know, their benchmark reading, the PMI, a reading above 50 indicates growth, a reading below 50 indicates contraction. Well, for the month of February, the PMI came in above 50 for the second consecutive month, something it hasn't done really on a consistent basis prior to that for roughly a year. And really before that too, there were a few mini growth pockets, but overall it had been largely down to the tune of something like 27 of the previous 29 months or so. I don't have that in front of me, but it was something like that. It was not great. Um, so when we look at manufacturing and industrial economy, Keith, as it relates to things like freight flows, supply chain logistics, throughput, etc., how would you sort of assess it on maybe on a year-to-date basis? Or it feels like maybe things are starting to turn the corner, although on the other side, manufacturing employment does remain down. So it's kind of a mixed bag, I guess.
Yeah, absolutely. And one of the things that I watch specifically down inside the ISM indexes is I'm carefully watching the new orders index, and then I'm watching also the inventory numbers. And if you look at the new orders index, new orders were still expanding, even though they're a little bit
Yeah,
softer than a really hot January number that we got. They were still expanding at a pretty rapid rate. And then I went down and I looked, and you see manufacturers' inventories, they're balanced. And then their customer inventories were way too low, right? And so I think that sets up a pretty good moving forward environment based on that. And then, Jeff, I also go out and I go look at a number of different readings around the world. So we look at 30 different PMI readings across the globe, our biggest trading partners. And what we saw was generally all but about four countries had manufacturing sectors in expansion. And that's a first. I haven't seen that probably in a little over a year or more. And so I agree with you. I think you're right on that we are seeing a turn, and that turn and that shift looks like it's more of a fundamental turn, something that's kind of rooted in some solid fundamentals that'll allow it to be sustained, and that
yeah,
momentum I think we can carry into Q2 and then into the summer. Barring something major and unexpected, like maybe a war in the Middle East.
yeah, yeah. And we will definitely get to that in a few minutes. Um, another notable thing that happened earlier this year, Keith, was the change in leadership or the pending change in leadership at the Federal Reserve with President Trump signaling that Kevin Warsh will be coming in and replacing Jay Powell in the coming months. Obviously, we've seen, I don't want to call it drama, but we've seen a lot of back and forth between the Fed and the White House. But putting that to the side, we have seen a bit of a shift in rates in recent months. I believe the next rate announcement's coming, I want to say next week or the week after. I believe it's coming on the 17th when they meet, and the Fed meets in March 17th, 18th, I believe. But anything notable here with the appointment of Kevin Warsh and just the rate in general? What are some things maybe from an industry, supply chain industry stakeholder logistics perspective that people should maybe just be paying attention to in the coming months as it relates to that?
Yeah, so I'm gonna get a little bit out in the financial world here for just a second because I think
Yeah,
it's
of course.
important, and it's fundamental. So we watched two different key interest rates. So the Fed funds rate, the Fed effective funds rate, is really short-term borrowing interest costs. But then you have the 10-year Treasury, which is the longer term. And what we just saw in the 10-year Treasury was a nice drop in the 10-year rate right before we got into the war. And so it dropped below 4%. And when that happened, Jeff, we saw a 128% increase in mortgage refinancing activity. We also saw an 8% increase year over year in brand new mortgage originations. And that shows the sensitivity right now to interest rates overall.
Yeah,
And as we know, like in freight and transportation, one brand new home will generate about seven full truckloads of freight volume. And so it's critical and it's important in what happens in the freight economy. So the 10-year and what the Fed does historically have kind of moved together. And so when the Fed cut rates, we usually see the 10-year Treasury move. But the Treasury rates are typically real sensitive to geopolitics, so anything happening around the world that scares them. And they're also sensitive to deficits, and they're sensitive to inflation. What the Fed's watching is the labor market and inflation. And the Fed right now just got a very weak labor report this morning.
Yes.
Yeah, we shed about 92,000 jobs,
Yep.
some of it weather related and strike related, but the underlying impact there is a weak labor market. And with a weak labor market and GDP kind of humming along at expectations, and what I believe is maybe some cooler inflation data before the war started, I thought we had a Fed that was probably going to be poised to trim anywhere from another quarter point, maybe two, maybe even three this year. If the labor market continued to get weaker, there are calls out there for maybe 100 basis points. Now, moving Warshin doesn't change, I think, the direction of the Fed. I know a lot of people are afraid that he'll come in and start rubber stamping stuff, but he's got a board of governors behind him and they rotate. And we're getting four brand new board members. Two of them are definitely hawks, so they want to see interest rates typically go higher for longer. Two of them are kind of moderate, but there's not a dove that's replacing any seat on the
Yeah.
Fed. Yeah, so you're generally going to continue to have a pretty hawkish Fed in general, despite, Kevin's direction trying to get rates down. So I think it will remain data driven. And with that in mind, again, so we're going to start flipping and we're going to be watching the signals. So we're going to be watching GDP, inflation, and labor. And at least one of those signals right now is kind of giving us some concerns. And last thing I would say on this is labor data is usually a lagging indicator. By the time you see it, it's too late. And so they typically will want to get out in front of it. And with the war right now in the Middle East, and we see a surge in oil and gasoline and diesel
Yeah.
prices, a lot of energy
Yeah.
prices, I think they're going to be fighting an internal battle over, do we worry about inflation or do we worry about labor? And that's what the fight will be over.
Okay.
And so I think in the next meeting, those are the key words we're all going to be listening for. But since the war started, the 10 years gone the wrong direction. We're moving back up around 4.2%. And that would be my bigger concern right now for the overall economy is watching that 10-year bond.
Okay. All right. Understood. And anything over 4% is usually viewed as problematic. Is that fair?
Yeah, well, not problematic so much as under 4% is a psychological threshold that frees things up.
Okay.
So right now in that low 4% range is exactly the environment we've had for the last couple of years. So, it's not dismal, it's not terrible, but it's just not exciting. It's not a catalyst.
For
When it
sure.
moves
Okay.
below 4%, all of a sudden we start changing our economic outlook. We start changing the trajectory of things. And that's the exciting part of it. If it goes to 3.5%, we would be completely changing our freight outlook for the year. We would be changing, our retail forecast. We'd be changing a lot of things in the outlook.
Okay.
That's
Okay.
how important that is.
Yeah. No question about it. All right. Let's move over to tariffs, Keith. Obviously, there's been so much going on. And just to kind of uh, list some of the notable events on February 20th. The Supreme Court ruled against the White House in regards to the legality of the implementation of the IEEPA tariffs, the International Emergency Economic Act, that is, Protection Act. So that was obviously a very big deal. So that was one part. The White House came back and said, well, hey, we're going to implement these Section 122 tariffs to the tune of 10%, and they're going to go up to 15%. Um, and then the Court of International Trade um, this week also has been very active too, and 24 states, in fact, have come and said they are going to sue to block the implementation of the 10% tariff. So, I mean, gosh, there's a lot of moving parts there, Keith. How do you sort of view everything that's happened? In regards to that. Oh yeah, and also the Court of International Trade is ordering refunds of the IEEPA tariffs following the Supreme Court ruling, which we wrote about in Logistics Management yesterday, and I erroneously forgot to mention. So sorry for that word tariff salad, Keith, but there's just so much cooking there. And how do you sort of peel the onion on this stuff?
Yeah, so we need an hour just on this, right? So
Yeah,
let me see if I can break it down. First of all, and I think the most important thing right off the top is that stock markets, supply chain managers, freight carriers, business leaders all hate uncertainty, right?
of course.
It just throws them into just a holding pattern, right? We want a bunker. And unfortunately, this whole situation, that's what it's done, is it's created so much more uncertainty. So when the president came out of the blocks right after the Supreme Court ruling, he mentioned 10%. Most of the trade agreements around the world that have been negotiated were at 15%. And except for the UK was at 10, everybody else was at 15.
Right.
That's why he adjusted it. And I think as of today or tomorrow, it officially goes from 10 to 15%. And that's what the new Section 122 tariffs will be, 15. And the reason for that is because he wants to make sure, and I'm not promoting this at all. I don't want to make it sound like I'm best friends with him or anything like that. That's not my point. I'm just trying to get in his head a little bit, which is
Right.
impossible, but we're trying. Uh,
Yes.
but the reason why they bumped it to 15% was so that anyone that we have a trade deal on the books with or that we've negotiated with, that they want to leave that trade deal intact, right? So they don't have a reason to go out and say, well, you negotiated the deal at 15%, but Supreme Court says most you can do is 10%. So we'll just, eliminate the trade deal and we'll just go with what the court said. What he did is he bumped it to 15%, the 122 tariffs, so that they have no incentive really to jump off the trade deal, stick with the trade deal. It becomes permanent, it gets locked in.
Yeah.
So for a supply chain manager, I think you're looking at those trade deals and those take precedent and those get locked in. We have those trade deals basically inked in with all but maybe four or five major partners. Two of them are the ones that matter, and be India and China. And I think you can move with certainty in those markets. But with the remaining deals like China and a couple of others, we're going to have to watch those negotiations because those are going to be volatile still. Now, what the administration is going to do is they're going to go in and they've started investigations on 232s and 301s. That's what they're going to use to create the long term, what we call durable tariff policy. And so the nice thing is, from a supply chain perspective, you can go in and you can get a fair warning on what those investigations are and what they're looking at, what sectors they want to impose those on. But typically, those 232 and 301 tariffs are a little bit higher than what you would see in like a Section 122 that's just a big, broad application of a tariff. Because as we get to July, you get to July 24th, and those 122 tariffs will expire. And the question is what's left after that? Well, the trade deal would be those enduring tariffs, and then the 232s and the 301s would be enduring.
Yeah.
And so that's what we're watching. So we have worked through a number of scenarios, and there's three basic scenarios. One is that Congress would step in and say the 122s are not only legal, but we're going to allow you to extend them. So we're going to go amend the policy and let it last beyond 50 days or 150 days. The likelihood of that is almost zero, right? You don't have enough support even on the Republican side of the fence to do that.
Yeah, that seems to be the general consensus that they won't go for that.
That's it, absolutely.
Yeah.
And the flip side would be that the 122s are ruled illegal. There's such a short duration of the 150 days that by the time it gets through the courts and you get to a ruling, chances are, and I can be proven wrong on this, but chances are you're not going to get a ruling on them saying, hey, they're illegal, you can't even apply those. So then what's left is the 122s expire in July and they get replaced with the 232s and the 301s, and we think that happens. From an economic perspective or a supply chain perspective, there's not a lot of advantages in trying to get ahead of that, like pre-ordering and trying to bring things in advance, until we know what's being investigated. And once we know what's being investigated, then we could see those supply chain strategies really start to play out. People trying to figure out, do I get ahead of it before a 301 or 232 gets applied, or do I ride it out and just go with the trade agreements that are locked in and use that as sort of my prevailing rule. And so that's if that scenario two happens, that what we're projecting right now is no change in GDP, maybe a slight increase in some inflation, but overall, long term, it would be basically no change. You would
Okay.
the inflation rate that we see today is what we'll get. Supply chains will have already adjusted to that 15% rate. We will have absorbed a lot of it up and down the supply chain. Every node of the supply chain taking a little percentage of the tariff impact and spreading it out. And that would be maybe a best case scenario. I am concerned though that you look at steel, aluminum, and copper tariffs right now. Those are pretty heavy tariffs with the 232s and the 301s. And so, if they aim that at pharmaceuticals and say it's a 200% tariff on pharmaceuticals, well, that's a big deal,
Yeah.
and that's what we're trying to find out. That's what we're trying to listen for, and that's what we're going to be watching for.
Okay, got it. It's interesting in 2025, Keith, with all the tariff activity, kind of stops and starts. In some times it was viewed as spontaneous or kind of what's really that whole uncertain drumbeat or tempo. But at the end of the day, United States bound imports still were up slightly for the year, which was kind of crazy. But I mean, obviously, there's a lot of pull forward and front loading activity that went into that. Um, Given everything that you just mentioned about tariffs, and obviously the key part being they are lower. Uncertainty still remains with that 150-day time frame that we had just alluded to. I guess with that as a backdrop, without having a crystal ball, obviously, um, do you think that US bound imports will remain on the right side of growth in 2026? I have seen some forecaster indicating maybe that won't be the case. So I'm just curious to get your take.
Yeah, I mean, I think it's going to be volatile. I don't think it's as simple as us being able to say, that the fundamental economic growth or reshoring or nearshoring is going to have a big fundamental impact. I mean, generally, supply chains and the way we were moving goods last year is still somewhat in place this year. You're not going to, it takes 3 to 5 years to go build a new manufacturing facility and to move actual production. And
Yeah,
we do have some manufacturing projects that were started in 2021 and 2022 that are finally delivering. And so you're starting to see some manufacturing come online. But that's materially not going to have an impact, I think, on global, freight movement. Now, where that freight is coming from is obviously starting to diversify, right? So if it was, significant, dominant China inbound, now we're seeing diversification. You're starting to see it throughout Asia, India, and maybe more cross-border with Mexico. So you're still seeing the volumes, I think, and we'll still see that solid growth trajectory based on how we source products. Now, the unknowns are we're starting to project maybe a micro, like a semiconductor problem somewhere starting around the third quarter, maybe the fourth quarter, spilling over into 2027. And that might have a material impact on what we see inbound, but that's a different subject. It has nothing to do with, where we source or where we plan to source. It's whether that source is available to us. And
okay.
I think that's the bigger thing that we're going to have to watch. Probably a completely different discussion. But just for context, I mean, Iran is the source for about 30% of the world's neon, and neon is critical in the making of semiconductors. And you've already got, conversation out of South Korea and Japan, Taiwan, and other places that the war is about to impact their ability to crank semiconductors out.
Yeah.
And we already knew that the timeline was that, automotive industry and some discretionary sectors were going to start seeing that pressure emerge in Q4 and Q1 of next year. And the war kind of accelerates a little bit of that timeline. And so we're watching that more from a supply perspective and trying to figure out, how fast forward does that move the timeline? How quickly does it hit automotive? How many chips do they have in stores? Those kinds of things. And so I'm more worried about those kinds of disruptions impacting inbound freight than I would be, a supply chain manager suddenly deciding to completely change maybe how they're sourcing. There's still going to be a lot of international sourcing hitting ports. Then again, they may just be diversified on where it's coming in from.
Okay. Yeah, understood. Understood. And I know we've alluded to the Iran conflict a few times here. Obviously, the oil and gas impact cannot be emphasized enough. You just talked about Iran being a major producer of neon, which is something I actually was not aware of. What are some others? I mean, we can start with oil and gas, obviously, but in terms of the impacts, and it's only been a few days, right? But I mean, what are some top of mind things related to the conflict that supply chain managers really need to be paying close attention to?
Yeah, I mean, there's a lot going on right now. I still think, the Red Sea situation and the Strait of Hormuz are the two choke points to watch.
Yeah.
We were seeing the Red Sea opening up, and now I think with just enough uncertainty, I think that the throughput has actually been dropping quite a bit kind of through the region. it's still technically open. The Strait of Hormuz is still technically open, but there's no one willing to transit it right now. Even with the U.S., if the U.S. is willing to go in and start providing escorts and insurance riders to make sure that a tanker can get through, we've had too many tankers still hit. You've got drones, and now what we've got are what they call, I think they're USVs, unmanned surface vehicles. They're the little boats that look like fishing boats that are unmanned, that are basically drones. And we're still trying to get information out of it, but it looks like a tanker was hit maybe in the northern Persian Gulf this week, and that would be sort of a new level of uncertainty in the strait. The problem is that those fly under the radar. You can't really see them very well, and then trying to knock them out. There's just there's 954 miles of coastline
Yeah.
on the Iran coast that goes from the Strait of Hormuz to the northern part of the Persian Gulf, and so securing that strait is not just about throwing a whole bunch of battleships down in the choke point, that 30-mile choke point, and making sure that nothing hits those tankers going through there. It's everything upstream in the Persian Gulf, and that's just too much land to cover. So we're going to have to get to a point where we probably see a ceasefire before you start seeing real, honest material, 100 tankers through the strait every day
Yeah.
before we see this situation kind of calm down. And that's the problem. And that's the reason why right now, as you and I are sitting here recording, I mean, WTI is at $88 a barrel, Brent's over 91.
Yeah.
Um, you've got a lot of concerns out there. Then, from a trade perspective, I mean, Iran was a critical provider of a number of different materials. Fertilizer is one of those. So, urea content, they provide somewhere between 20 and 25% of the world's urea. And so, we know that the farming community, urea prices for fertilizers, and right now is a critical time for farmers. You've got wheat and corn planting, and they need the urea to kind of help them get a good start. And those prices are already up 25 to 30%. And so, not a lot of good substitutes for that. As I mentioned, neon, and there's other materials that go into chip making, and Iran was a good source for that. So, best case scenario, someone else is able to kind of step up and maybe start to fill that supply gap. Worst case, or and that means with a price hike, right? So we see the price of those semiconductors go up as a result of those higher input costs. Worst case scenario, we do see shortages in semiconductors pretty quickly. Because Jeff, at the same time, I mean, you got to look at a defense sector that's going to have to really ramp up because we are
Hmm.
depleting a lot of munitions very, very quickly. That's good news from like a U.S. defense industrial base, right? We see that volume, we see that freight movement, and there's going to be urgency around it. I don't know that it's a Rosie the Riveter moment yet, but I do know
Hmm.
that there's a meeting at the White House today with the president and a lot of defense contractors to figure out how can we uh, expedite and accelerate the production of munitions. And in doing so, and some of the conflicts in Ukraine, you now have a global scramble for some of those materials. Copper wiring, semiconductors,
Yeah.
anything that goes into the smart weaponry that we're using today. And so there is going to be a little bit of an impact from that. We've got to kind of look over our shoulder and kind of watch our back a little bit on what's happening with some of that material availability and the cost of those materials. And then, of course, that's the concern, is that then you get the inflation kind of rippling through the economy, and especially with petroleum prices going up. I, I didn't even mention, I mean, the biggest concern I think in the supply chain is the price of diesel. And I
Yeah.
I think I can't believe I almost blew over that. Yeah, I mean, that's the big thing right now. And diesel prices, I'm just looking right now. I mean, they're 4.33 this morning, or as of yesterday.
Yeah.
Yeah, so I mean, we're up already almost 65 cents a gallon. I will tell you this, from a carrier perspective, like in trucking, historically, I mean, when you go back to 2008, we go back to 2022, at about 4.60 a gallon, we started seeing material loss of capacity in the trucking industry.
Yeah.
A lot of smaller firms who just don't have the cash flow, they can't float those invoices, and they at our point where they literally cannot fill their trucks. And so,
Yeah, no doubt, Keith. And to that end, even prior to the conflict, I believe weekly diesel prices, as per the Department of Energy's Energy Information Administration data, had already been climbing for, I believe it was 8 straight weeks. So, Clearly, a big jump is underway here, and that, as you're indicating, not good news, especially on the motor carrier front.
Yeah, so yeah, kind of wrapping up on this whole Iran thing. I don't know how it's going to end. And from a supply chain perspective, yeah, diesel is probably the biggest impact. I think maritime movement and adding another 11 to 12 days of transit around the Cape of Good Hope, I think is going to be kind of the norm for at least the short term. I don't know if this is another week. I can tell you this. I do know a lot of White House analysts and a lot of those of us who are watching this say from an economic perspective 30 days of disruption seems to be that critical point. It seems like if we go up to and beyond 30 days, then we start having a material global impact on the economy. If we see kind of conditions continue to be volatile inside Iran, but you see the rest of the Strait of Hormuz and Red Sea and other areas, other Middle Eastern partners starting to free up the flow of goods and the movement of materials, then we probably see this whole situation calm down and the economy kind of reverts back to sort of fundamentally where it was before the conflict started, and off we go.
Sure.
So we've got some critical weeks ahead of us. I think everyone's going to have to really pay attention to.
Absolutely. And Keith, before we wrap, I just thought we could do a real quick kind of a rapid fire, I guess, on two quick topics that popped up while we've been talking. And one simply is, I guess I'll just label it generically, the AI impact in terms of the impact of AI on logistics and supply chain operations and uh, subsequently the logistics and freight economy. It's moving at such a rapid clip. I mean, from an editorial perspective, I can safely tell you that my inbox is full every day with at least a couple dozen AI related pitches as an example.
Yeah.
So I'd just be curious to hear your quick thoughts on the AI impact here.
Yeah, I mean, I think anyone who's running from it, anyone who says it's a fad or anything like that, I think is, not gonna do well. I think as we move through this, but as we've heard many, many times in many conferences that you and I both have been to, it's one of those factors where it's how you apply it, and I think those that are most successful with it are using these, small applications that really help improve productivity and help workers do what they do much better. That human to human contact is still critical inside the supply chain. But my goodness, the capability and just the kinds of resources it can bring to bear and how much smarter and more intuitive it can make decision making, I think is just something we can't miss. So the impact is there. Now, of course, the negatives are going to be on the labor front, and we still see estimates all over the place. I'm still going with a conservative estimate, and I still believe about 4 million US jobs get replaced by AI. We create about a million at the same time, so we've got a net loss of about 3 million. What we think, though, is that that happens maybe over the next 36 months or so. But amid that, in the middle of it, is you have a heavy baby boomer retirement trend that's accelerating. And by 2030, we're going to lose about 22 million baby boomers to retirement. So I think
Hmm.
what's going to happen is so many people who are getting replaced by AI, it's like career change time, right? They just got to rethink what they do or how they do it, and so they shift over. So
Understood.
so for the supply chain, it gets smarter, it gets better. Near term, we got to worry a little bit about the consumer side of things and what happens if we start to see like labor reports like we got this morning, where we do see, a loss of almost 100,000 jobs in a fairly good economic environment. So we know most of that's going to be kind of related to AI job replacement. I would tell you there's a couple of things we watch out there, like the Challenger report. And the Challenger report had the worst February for layoffs that it's had since 2009, and it had the worst January it's reported since 2009, all of it AI related. And so,
Yeah. Yeah.
yeah, so we know the impact is there, but I just think the upside potential is just too great for everyone to overlook it. We're all going to be forced down that path.
Hmm.
And you can either go kicking and screaming, or you can embrace it and run with it and, take on the productivity and what it does for you. Understand its limitations, understand when it's wrong, understand how to avoid those mistakes, but it's definitely here to stay for sure.
Yeah, no, hard to disagree with that. And this real quick, Keith, the other question I had is coming up. Mid-year, July, will be the formal joint review of the USMCA, United States Mexico Canada Agreement. Um, it's a pretty fair question to say what happens with this deal. Will it continue? Will they become separate deals? U.S. Canada, U.S. Mexico? No one really knows. Especially when you look at the tension between the U.S. and Canada too. How do you sort of assess, what we might be in store for with that joint review coming up in July?
Yeah, I wish I could be a cheerleader here. I really do. But based on what I've seen over the last year and a half, I think we can expect the unexpected. And so, unfortunately, I'm going to have to go into it knowing that it's going to be volatile. It's going to be ugly from a negotiation perspective. We're going to hear things that are going to scare us to death if we have operations in Mexico, and Canada as well. I think ultimately, from a strategic perspective, though, the USMCA is the greatest strategic and most important, most imperative relationships that we have around the world. And so I think that ultimately kind of rules the day. We need a
Yeah.
strong and secure Mexico, including a strong Mexican economy. We need a strong Canadian economy and a secure Canada. And I think ultimately those will rule the day. I just think it's going to be like almost like a union labor contract negotiation where publicly, we hate each other and we're at each other's throats. But behind the scenes, we're actually making progress. And then, we have the Kumbaya Day where we announce we have an agreement. And it just feels to me like that's kind of where we're headed.
Okay. Okay. Understood. Well put. Well, Keith, this brings us to the end of our today's podcast. So, on behalf of Logistics Management and the Peerless Media Supply Chain Group, I'd like to say thanks for spending some time with us again.
Absolutely. Always my pleasure. I love it.
Yeah, it was so great to have you on. And for those listening in, if you want to connect with Keith on LinkedIn, that's really easy to do. Just go to linkedin.com/in/Keith Prather, and that's Prather, followed by one more backslash. And then if you want to learn about Armada Corporate Intelligence, pretty easy URL. It's just Armada, Armada Intel, armadaintel.com. And if you're not following us on Twitter, please go ahead and do so. We're at Logistics MGMT. And please, I encourage you to sign up to subscribe to the Logistics Management Podcast. Wherever you get your podcast, just go ahead and enter the Logistics Management Podcast, and it should be right there. Thanks, everybody, and have a great day. We'll catch up with you soon.